Well, as we've told you, Suncor Energy has raised its quarterly dividend by 12% to the highest level in its history. This comes after the oil sands giant made a profit of nearly $3 billion in its latest quarter. The company is also discussing some asset sales. All of this comes, of course, as the company is under pressure from an influential and unhappy investor. Let's bring in Rafi Tasmanian. He's Senior Portfolio Manager at Canoe Financial. Rafi, we're very glad that you're able to share a little bit of time with us. Let's begin with the Suncor story and then move on to the sector more broadly. The Suncor Energy on the conference call, as I'm sure you know, making some comments and just indicating a willingness to talk things over with Elliott Management. How is this important to shareholders?
Yeah, that's really important because the results that they published didn't make it easy on investors to distinguish between what Elliott ultimately wants and what Suncor is offering, because this was a good report. It's been several quarters since they've been able to publish productive reports like this. And while all the other peers have been doing that, getting more productive and getting the flow of the market and getting the confidence of the market and grabbing the momentum, Suncor has been sinking with problems in the last quarters. This quarter came out materially better than prior quarters. It's the first one. And so it gives shareholders pause in terms of Elliott's changes are not dramatic changes. And so I think the right thing for Suncor to do is to say to unit holders, don't worry about it. We're going to talk to Elliott. We're going to figure out what is going to make them happy. Let's see if there's something we can do with them and allow the intellect to work between the two parties. I think for Elliott, though, it's an absolute win-win situation for them because this whole group is just violently undervalued in the market today, in spite of, regardless of where they've come from, because these stocks are up dramatically since March of 2020, but not nearly commensurate with where the commodity prices have gone and the profitability of this group. So they're still relatively alienated from investors. That investor flow is starting to come in now. But I think Elliott looks at this like this is just a cheap equity to own. If we can disrupt some feathers and try to create some more value quicker, that's even better. This was an easy activist situation for them, I think.
It's interesting to hear you say the investor flow is just starting to come in now. I think what you're referring to there is the so-called generalist investor, money managers who manage lots of money, who have for years shunned the energy stocks for a variety of reasons, low commodity prices in the recent past being one of them. But is it really the case that that money is only beginning to come in now after we've seen energy stocks rise in some cases by well more than 100% over the past year?
Yeah, the party that was able to enter and had the intellect to understand the value and the change in what the industry is doing, going from a growth model to a distribution model, they're in, and that equity's in. But the generalist that was kind of exited the old economy for the last decade and either didn't want to be there or couldn't, is really starting to, that momentum has shifted. They are. And one of the big reasons is just using the S&P, the energy index was 1.8% of the S&P at the bottom. It's touching 5% now. So every day that energy equities are up and the broader markets are down, it accentuates the pain of a generalist that's not in there. So it forces them into the sector as well. If they don't get in, and then they will, and they're not allowed in, then they will compare themselves to an index X, the energy index, just to give themselves a fighting chance, because this index is very, very cheaply valued and has got a long ways to go, I think. Okay,
what's your view on commodity prices, and can share prices of energy producers continue to rise if crude oil plateaus at where it is right now, which is still a very high level compared to where it's been in recent years of about $105 per barrel?
Yeah, we tell people, Paul, that for equity prices to go higher, we want commodities to go lower and stabilize. So unfortunately, we don't think that's going to be the case in the long term. We just don't see that the attack on supply, the inability for producers to grow through onerous regulatory issues and just a general malaise by the market for those who want to grow have prevented the supply from reaching the market. That's why you're seeing higher commodity prices. That's why you're seeing higher gasoline prices. It's not because the producers are trying to reap profit. That has nothing to do with it. I think there are a lot of politicians trying to use that argument, and I think that's very irresponsible of them to say that. This is all about a lack of supply in the system and an inability to get that supply to the market. And I don't see that that's going to change in the near future. It requires enormous amounts of capital. It requires significant infrastructure, which we're preventing from being able to get there. So ultimately, Canadians are going to have to expect higher energy costs. And the best way to offset that part of the inflation model is going to be owning this sector. I highly recommend that. We have another inflation component, which is the supply chain issue. That's going to get fixed as we fix the supply issue. But we're not going to fix the commodity supply issue in the short term. Huge amounts of capital are required and a mindset change in the market to allow this industry to grow again. But until then, we've got higher costs coming. These stocks are going a lot higher, and the valuations of them, I mean, they're already set up to distribute the money back to back to investors. So really, everybody should have a sleeve of this type of investment in their portfolio.
Okay, we're almost out of time, unfortunately. Can we finish with natural gas prices also sky high, perhaps less followed and less easy to follow than crude oil prices? There are several natural gas benchmarks. Give us the lie of the land on natural gas and where you see prices over the next year.
Yeah, the biggest thing investors need to understand is historically it was a very captive price to a region because it was hard to transport to other regions. As we've built out massive infrastructure prior to the recent setbacks, and there seems to be an acceptance globally outside of Canada to grow LNG markets. These LNG markets have allowed gas to become a more global market. Last week we heard ARC had done a transaction with Cheniere in the US. Tourmaline had done one earlier in the year as well. So Canadians are moving our gas to those LNG markets. Unfortunately, we are a secondary product pricing because we're selling it to an LNG market as opposed to creating our own. But we are going to start to benefit as the global infrastructure of natural gas gets built out. And it becomes, it really has been the energy transition commodity of late. We don't see that really alternative energy sources have been any transition or any threat to transition at this point. Natural gas is and will continue to be. So we see less volatility on the downside, more volatility on the upside for gas. And I would share the sentiments I did earlier with oil stocks. I would own these as well in your portfolio.
Rafi Tasmanian, thank you a great deal. He's Senior Portfolio Manager at Canoe Financial.